Today's report on Buffett's 5 Japanese trading houses, Itochu, Marubeni, Mitsubishi, Mitsui, and Sumitomo, is a reminder that Buffett is not just looking for cheap stocks. He is looking for businesses that can keep producing cash, return capital to shareholders, and compound value over time. The first metric Buffett focuses on is earnings power. He wants to know whether the companies can generate stable profits across cycles, not just in one strong year. The second is valuation. Buffett likes when he can buy strong businesses at a price that leaves room for error, and these Japanese trading houses have often traded at relatively modest earnings multiples compared with their cash generation. The third is shareholder returns. Buffett pays close attention to dividends and buybacks because they show whether management is actually sending cash back to owners instead of just expanding for the sake of size. The fourth is capital allocation. He likes management teams that reinvest wisely, avoid waste, and treat capital as something scarce and valuable. The fifth is balance sheet strength and diversification. These trading houses operate across commodities, logistics, consumer goods, energy, and investments, so Buffett can get broad exposure without betting on one narrow industry. Let's look at Buffett's 5 Japanese trading houses one by one. Itochu stands out for consistency. Its latest financial report shows strong operating cash flow and a healthy cash balance, which matters because Buffett likes businesses that can turn earnings into real cash. Itochu's capital allocation framework also emphasizes balancing growth investment, shareholder returns, and financial discipline while keeping leverage under control. On the balance sheet side, it looks relatively conservative for a company with global exposure. Marubeni looks solid, but more cyclical. Its recent results show positive operating cash flow and only modest free cash flow after investment, which suggests management is still putting capital into the business rather than just harvesting cash. Buffett would care less about one quarter and more about whether that spending earns good returns over time. The balance sheet appears manageable, but the key question is whether capital deployment keeps creating value through the cycle. Mitsubishi Corporation is the scale player. Even where free cash flow can be volatile, Buffett would focus on whether core operations keep producing durable cash and whether the company remains disciplined with investment and buybacks. For a trader like Mitsubishi, the balance sheet matters because the business spans many sectors and can carry exposure across commodities and investments. The main appeal is breadth, but the challenge is proving that breadth earns acceptable returns. Mitsui looks especially close to Buffett's style. Its report shows core operating cash flow remains strong, even when working capital and financing flows move around. That is important because Buffett cares about the cash a business produces after normal operations, not just accounting profit. Mitsui's balance sheet and capital allocation are also designed around maintaining flexibility while still returning cash to shareholders. Sumitomo is usually the most conservative of the group. Buffett would likely focus on whether its earnings are stable enough to support consistent cash generation and whether management can keep reinvesting at attractive returns without stretching the balance sheet. In this kind of company, the big test is not just growth, but whether capital is being used with discipline across cycles. What Buffett focuses on, the metrics Buffett would care about most are earnings quality, free cash flow, return on capital, dividend and buyback policy, and leverage. He also watches whether management keeps a balance between growth investment and shareholder returns instead of chasing size for its own sake. For these trading houses, that means he is less impressed by headline profit alone and more interested in cash conversion and disciplined capital recycling. If you want the simplest Buffett-style ranking from this framework, Itochu and Mitsui look the strongest on consistency and discipline, Marubeni and Mitsubishi look more cyclical but still attractive, and Sumitomo is the most conservative long-term fit. The real test is whether each company keeps turning reported profit into free cash flow and then returns that cash intelligently. Below is a Buffett-style read on the 5 companies based on the latest reporting signals we already gathered. The short version, Itochu and Mitsui look the closest to the standard, Marubeni and Mitsubishi look acceptable but more cyclical, and Sumitomo looks solid but harder to judge without the full report details in hand. Itochu looks strong on earnings quality because its core profit is backed by solid operating cash flow, not just accounting gains. Its capital allocation also looks Buffett-friendly. It is using cash for both growth and buybacks, while keeping a relatively conservative equity ratio near 40% and a payout ratio around 52%. That combination suggests it is not chasing size for its own sake. It is trying to compound value and return cash to shareholders. Marubeni appears to meet Buffett's standard, but with a more cyclical profile. The company has emphasized progressive dividends and flexible buybacks, and its payout framework has been moving higher, which is a positive sign for capital discipline. The caution is that free cash flow can be more uneven after investment, so Buffett would want to see that growth spending keeps earning acceptable returns over time. Mitsubishi looks decent on earnings quality and capital returns, but it is less clean than Itochu in pure cash conversion terms. Management has said it delivered very high total shareholder returns, including large buybacks, while maintaining a strong credit profile and positive free cash flow after shareholder returns. That is a good sign for balance sheet discipline, though Buffett would still watch whether the company keeps earning enough on its diverse portfolio to justify those investments. Mitsui looks like a strong Buffett-style holding because it has reported robust core operating cash flow even when other cash flow items move around. That matters because Buffett cares most about cash a business can reliably generate from operations, not just reported earnings. Mitsui's profile appears to support dividends and capital flexibility without obvious balance sheet stress, which is exactly the kind of setup Buffett tends to like. Sumitomo likely clears the Buffett bar on balance sheet caution and long-term resilience, but it usually needs a closer look on capital efficiency. The key question is whether it is converting earnings into durable free cash flow and then allocating that cash with enough discipline to justify holding it over a full cycle. On the information we have, it looks acceptable, but it is the one where the evidence is least direct in this set. If the test is earnings quality, free cash flow, return on capital, dividends and buybacks, and leverage, then the ranking from strongest to weakest looks like this: Itochu, Mitsui, Mitsubishi, Marubeni, Sumitomo. The main reason is that Itochu and Mitsui show the cleanest mix of cash generation and capital discipline, while Marubeni and Mitsubishi are a bit more dependent on cycle and portfolio mix. Sumitomo seems sound, but I would want the full report details to judge it with the same confidence as the others.